Well, hello everybody. Welcome back to Sunil's Forex trading tips. And today, what we're going to talk about is risk management. One of the most crucial factors about trading. This is something which not a lot of people talk about it, but I wanted to go over it. So, in today's video, short video, we are not going to discuss any trading systems. We are not going to discuss Fibonacci's. We are not going to discuss anything. We're just going to go over the calculations of risk management, the two golden rules of risk management. That's about it. Because I feel personally, and I've seen it, it is one of the most important trading factors in your trading process. Now, most traders are aware of it, but unfortunately, in a very general way. So, people do talk about risk to reward ratio, risk management, money management, yes, but it's a very general thing. Risk management is actually the line between success and failure, but the trader must have specific rules. So, this is exactly what we want to cover. Let's start off with what I'm going to start off is my concept of 3Ms, which a lot of you are familiar with. So, the importance of applying the concept of the 3Ms in the trading process ensures your success. Now, the 3Ms I have defined as money, mind, and method in that particular order. Money is your risk management, which we will be talking about. The mind factor is nothing but the discipline and patience, and the method is your trading system. Now, I've got these numbers over here. So, if you distribute these three factors on a scale of 1 is to 10, your money risk management factor takes up 5 parts out of 10, the mind factor will take up 3 parts out of 10, and the method takes up only 2 parts out of 10. So you see, your trading system is actually the least important part of your trading process. Let's start off with the trading process. Like I said, I'm not going to go over it, but just briefly talk about it because we do trade on the charts, right? We, as traders, we look at the charts, and that's what your trading is all about. So trading system could be anything for today's video, or even otherwise, it's actually irrelevant as to what you're trading with. You could be trading based on fundamental factors. You could be trading based on certain algos. You have artificial intelligence. You have robots today trading for you. You could be trading based on technical analysis, which is what I tend to do. It's not important. What is important is applying the concepts of the money and mind to your trading strategy once you have a trading strategy, which, as you've seen, takes up only 2 parts of 10. And if you don't, your chances of success are much lower. Now, the novice trader, the new trader who comes into the market, usually trades with indicators, which are always lagging. To be very honest, let's be fair to the new trader. It's really not his or her fault. If you do a Google search today on trading systems, availability, etc., you'll come across thousands of websites, people offering trading techniques. Most of them, 90% of them, talk about indicators. So obviously a new trader thinks that this is the way to go. But there is a reason, and if you've seen my other videos, specifically on the introduction of the basics of Forex, how the banks and the brokers want you to trade with indicators, you'll realize how incorrect that is, but that's what trading is all about, right? So an amateur trader, when he starts, he takes up only 0.5 parts out of the 10 which he's supposed to follow. It's not surprising that the new trader fails. So this is just one of the main factors. But like I said, we are not discussing this today. The mind factor, I just wanted to go over it. Once again, this is a completely different trading topic by itself, a video by itself, which we will talk about. But overcoming personal emotions is one of the most difficult tasks of trading. As they say, when you're trading, you are trading against yourself. It's very easy to get swayed, and specifically when your money is on the line. You bend the rules, like you don't keep a stop loss. You let your losing trades run in the hoping they'll come back. You close out your profitable trades early, and then you just watch your trade keep going when you're not part of it. You get into revenge trading, which is a very common thing. It's just human psychology. Now, this has to be built up. Your mind factor, all these factors, they are a skill which have to be built up. No trader, I believe, is born a successful trader. He or she has to build up the skills, and the mind factor is a skill which comes from trading. which comes from experience. So, like I said, another topic by itself some other time, but I define the mind factor simply as discipline and patience. Patience to wait for the market setup as per your rules. So you must have a trade plan that I am going to trade with this system, whatever is your system. Let's say my trading system is the divergence. The primary trading system that I have is a base. Divergence is a base for everything that I do. And once again, if you've gone through the other videos, you see why it's so successful. So my patience comes that if I'm following certain currencies and I look at it, unless I have a divergence, I am not going to trade. Now, this is patience. And once I have my setup conditions as per my trade plan, that my divergence setup must have these conditions. Once I have that, I go ahead and I follow my trade plan 1, 2, 3, 4 steps like a pilot's checklist without deviating from it. Now, this has to you have to keep the emotion out of a trading, which is the whole purpose. So patience and discipline. All right, so let's get into the risk management. That's what we are talking about over here. The two golden rules of risk management. Like I said, people are aware of this, but I just want to put it down very specifically to these two factors. The first one, how much of your capital should you be risking on every trade? So do not risk more than 1% of your capital at any time. Now, this can be flexible. I can even go up to, let's say, 2 to 3%, not more, believe me, but 2 to 3%, which simply means that I can have 2 to 3 open trades, each with a risk of 1%, definitely not more. But I'm not going to take 3 trades each with a risk of 3%. That's something different. Personally, on my trading, I do not risk more than 0.5% of my capital on a single trade. And there's a reason for that, which we will come back to later. Right, so do not risk more than 1% of your capital. Keep that as a base. The second is your risk to reward ratio. Everybody's aware of what a risk to reward ratio is, and we will just have a look at that. Should be a minimum 1:3. Now, here, Forex gives you a huge advantage. A huge advantage. These golden rules can apply to any financial instrument. You could be trading futures, you could be trading commodities, you could be trading equities. You can and must apply these two golden rules over there. But it's more effective for Forex, and I say Forex is one of the best markets to trade. One of the simple reasons is that the currencies tend to have larger trends, which only increases your risk to reward ratios. And believe me, when we are talking about risk to reward ratios of 1:3, I've kept it over here. Just as a comparison, if I was trading the futures market, I would probably be happy with the risk to reward ratio of 1:1 or maybe 1:2. But in Forex, 1:3 is the bare minimum, because I've personally traded, I know traders, when a currency starts to trend, your risk to reward ratios can go to 1:10, 1:15, 1:20. That's the advantage. Which is why 1:3 for Forex is absolutely achievable, and it's nothing at all. It's like a walk in the park, I always say that. Another advantage of Forex is your trends are more prominent on larger term time frames. You should ideally trade on longer term time frames, 1 hour and above. Ideally, I personally trade on the 4 hours. More than that, I generally don't even come too much on the 1 hour, but I would say for a new trader, retail trader, 1 hour is good. You can get some good trade setups over there. Anything below the 1 hour, 15 minutes, 5 minutes, 2 minutes, well, the simple fact is, at the end of the video, you will yourself see that the rules of risk management do not work the lower you go on any time frames. Which is why you should ideally trade on larger term time frames in Forex, because that's where the trends are. And the advantage once you're trading on larger term time frames is you can just look at your charts 2 to 3 times a day. You don't have to be stuck in front of your computer, right? And stress yourself out every time price is going up and going down, right? That being said, let's have a look at one chart example explaining the risk to reward ratio. I mean, for those of you who are not familiar with it, for those of you who are not really familiar with the pip values as such, I'm trying to keep it very simple. So this was a trade, this was a divergence trade. It was a live trade. You can see that an order was placed right over here. It was a buy limit order. that if price moves up, I would get filled into the trade. This was the outcome of the trade. You can see the divergence quite clearly right over here. It was a bullish divergence, went right up to the target and turned exactly from the target. Let's have a look at the risk to reward ratios. So I have marked the entry, I have marked the stop, I have marked the expected target. Now remember, expected target. I don't know whether this trade is going to be successful or not. Once before it happens, it might just turn out to be a losing trade. Price could just keep going down and I could get stopped out, which is fine. Part and parcel of trading. But this is an expected target I talk about. It may not reach. Calculating the risk. Your risk is the difference between the entry and the stop. So I've put the figures over here, which comes out to 44 pips is your risk. Your reward is the difference between your entry and your expected target. I've done the calculation over here, which comes to 186 pips. Risk to reward ratio 186 divided by 44, 4.22 mathematically. So 4 times, so your risk to reward ratio, and this is 1:4. Remember, minimum 1:3, definitely more than 1:3, which is exactly what I want. Right now, just as a point, this is where your Forex or trading in Forex gives you an advantage. We use a lot of Fibonacci ratios, etc., where every trade that we take does give a minimum risk to reward ratio of 1:3. If it does not, this is where your mind factor will come in. And there could be some times where your expected risk to reward ratio is not 1:3. You are not going to take the trade. However nice it looks, you're not going to take the trade, and that is your discipline part of it. That's your mind factor. All right, that being said, let's get into the calculations, right? This is a trade which is completed. I'm going to take some assumptions over here. Let's say that I have a capital of $10,000 that I start trading with. And like I said, I'm going to trade on the 1 hour time frame. Now, if I have a basket of, let's say, 10 to 12 currencies that I'm following, which are the major pairs, the 7 major pairs, and certain cross pairs which give you enough of volatility, which give you enough trading opportunities, good movements, then would you say it's reasonable that in a week, if I'm following about, let's say, 10 currencies, I could get about 2 to 3 trades a week on the 1 hour time frame? I think it's quite reasonable. I'm not over trading, which you should not be doing. I'm not under trading. 2 to 3 trades a week is absolutely achievable. It's very practical if you're following these currencies, a basket of about 10 odd currencies. So let's say on average what I'm doing, I want to take calculations very simple. Let's say I take 10 trades a month. And I've not come to this figure just based on something. This is actually what we do. Even when we trade with our traders, this is an average that we follow. Roughly. It could be more, it could be less. But 10 trades a month is very reasonable, right? Achievable. You don't have to spend too much time over there. You're not over trading. Everything works fine. Now, let's have a look at the win-loss ratio. Let's say I have a win-loss ratio of 40%, which means out of the 10 trades, I am going to have 6 losing trades, only 4 winning trades. Now, this is practical, believe me. Professional traders have a win-loss ratio of roughly 60 to 70%. That means they'll have 6 to 7 winning trades. But when you're starting fresh, I would say that even if you achieve a win-loss ratio of 50%, that out of every 10 trades, you get 5 trades correct, you are an excellent trader, believe me. Losing trades are a part and parcel of your trading. Anybody who wants 100% successful trades in all that you do is just living in a fool's paradise, believe me. So I've kept it at 40%, which is again very practical, very achievable. I'm sure it's not very difficult to have 6 losing trades for all of you, right? I'm just kidding, of course. But so I want to take the absolute bare minimum over here for the calculations, that I'm taking 10 trades a month, which is absolutely achievable. And I'm going to have only 4 winning trades, which I'm sure I can do better. And I'm sure you can do better. But let's take the absolute minimum achievable figures. Going ahead with this, let's put down the rules of your money management. Your rule number 1. Do not risk more than 1% of your capital. Now, we are following this same rule for all the 10 trades. Let's say that all 10 trades that I've taken for the month, I am following those rules for every trade regardless. All right. So first, do not risk more than 1% of your capital. If I have a capital of $10,000, which we decided, my maximum risk allowed 1% of that is $100. So I am going to risk a maximum of $100 on this trade. This I have decided. You can keep this as 0.5% of 10,000. You can keep it at 2%. Flexibility is here, but I would suggest let's keep it at 1%. Now, on an average, if I'm trading on the 1 hour, from my experience, I've seen that your average stop loss, that the distance between the entry and the stop is roughly about 30 pips. On this example, earlier in the chart, we saw it was some 46 pips. So it could be 45, sometimes it could even be 25, but on an average, I've seen it's about 30 pips roughly. Now, if you're trading mini lots, again, for those of you who are not familiar with this, I'm just trying to put it down in dollar values. If I'm trading a mini lot, the dollar value per pip is $1. So which is why I want to keep it very simple. So if I have a risk of 30 pips, it straight away relates to a dollar value of $30 for the trade. So my risk is $30. Now coming back to my 1%. So there's this position size formula. It's a universal formula. Everybody follows this. It's not mine. You can do an online search of it. You'll get this. Position size is how many lots do I risk for this trade? So the mathematical calculation is the maximum risk in dollars divided by your stop loss value in dollars is your position size. Now the maximum risk in dollars here, it's $100 because I have decided it's 1%. If I would have decided 0.5%, it would have been $50. So maximum risk that you have to decide, right? So we've decided at 1%, which is $100, divided by your stop loss, which we just saw for a mini lot, it comes to $30. 100 divided by 33.3, which means for this trade, I can trade 3 mini lots. 1% of my capital. This relates to a risk of $90, which is within my 1% of capital. So I am following golden rule number 1. We'll have a look at golden rule number 2, risk to reward ratio. We've said that the average stop loss should be about 30 pips. That means my expected target for this trade must be 90 pips. So before I get into the trade, I calculate my target, which again, going back to the divergence, we use Fibonacci ratios, a Fibonacci projection value, which gives us the exact target. And as you did see right there on the chart example, price reached right there, bang on target, and turned on the pip from there. Believe me, they're very accurate. So I do have my targets in front of me before I enter the trade. So the expected target, once again, it may not reach, must be at least 90 pips. If it's not 90, I am not going to take the trade, right? Let's round this up to 100 pips just for calculation's sake, nothing else. I don't want to increase the risk to reward ratio, but just for calculation's sake. Let's go ahead and do the calculation. I want to do this calculation for 10 trades. So I'm taking 10 trades a month. I have a win-loss ratio of 40 to 60. Let's look at the losing trades first. I have 6 losing trades. Each trade has lost 30 pips, which is $30, and I'm trading 3 lots, right? That's what we decided here. So my dollar value loss for the month is 540. I have 4 winning trades. I make 100 pips out of each trade, which is $100, and I'm trading with 3 mini lots. So 4 into $100 into 3, $1,200. Net effect for 10 trades, $660. Now, look at this in this way. You are taking only 10 trades and you are losing 6 trades, but yet your account is growing. Now, this is the most important thing. This is just simple mathematics, folks. Tell me that I'm going wrong somewhere. Seriously, I mean, just mathematics. Tell me that this mathematics is wrong somewhere. Now, the cherry on the cake. You started with a capital of $10,000, right? You have a capital of $10,000 in 1 month with these conditions, with the absolute bare minimum conditions. You are making $660. What is your return on investment? That's a 6.6%. We are talking about 6% a month, folks. Come on, what do your banks give you? What if you put your savings in an equity fund, in a hedge fund? What are the returns that you're looking at on a yearly basis? Here you're looking at 6% a month. By taking just 10 trades a month, by losing 6 trades. Again, it's not, I don't want to get into the money part of it too much. I just want you to concentrate on the mathematics part of it. That this is completely feasible. It is. I know traders who do it. I do it. One more on top of this, risk to reward ratios, as I said, in Forex can go to 1:10, 1:15, 1:20. Let's just take it as I have a risk to reward ratio of 1:4. The same trade that we just had a look at the example, right? Instead of 1:3, 1:4. Now my risk, my losing trades remain the same because my risk is the same, nothing different. $540 I'm losing, but my winning trades, for every trade now I am winning 120 pips. So if you do this calculation, 4 into 120 into 3, this comes to 1440 minus 540, this comes to $900. Now you're talking about 9% a month. You have increased your return by 3% a month simply by getting a larger risk to reward ratio. And as you can see, the larger the risk to reward ratios that you can achieve, where you can take your account, it's just again simple mathematics, nothing else to it. You do the calculation. In fact, you have this slide, you have this recording, do the calculation, go ahead and change your risk to reward ratios, which most amateur traders want to scalp the market, and they will go in for risk to reward ratio, an inverse risk to reward ratio of 0.5 to 1, 0.5 to 2. Do the calculation and see where it's taking your account. Again, mathematics. End of the day, most traders do not concentrate on this. It's not that they're not aware of this. It's just that it doesn't register at that time. And emotions come in the way. You just have to follow your rules. End of the day, following the 2 golden rules of risk management is crucial to your trading success. It applies to anything that you trade. It works much better for Forex because your risk to reward ratios can be substantial. So follow the rules of risk management, trade less, trade selectively, and yet grow your account. That's it, folks. Short video, but I'm going to see you back for some other topics. You have a nice day.